Okay, this video is going to be cost of capital part 2. We'll pick up where we left off in the last video and take a look at the component cost for common stock. And we'll look at 3 different methods to estimate that component cost. The first one here is the capital asset pricing model. And here we can look at the cost of equity as just being the discount rate we're using to value stocks. We've already done this, and so we're just going to use that CAPM equation down here at the bottom, where we have the component cost of stock, R sub S, equal to the risk-free rate plus the beta for that stock times the market risk premium, which is this thing in parentheses here. One way to estimate the risk-free rate is to use a 10-year treasury. The 10-year treasury rates, those are going to be a good proxy in the context of capital budgeting because we typically are looking at longer-lived projects. So 10 years is kind of a reasonable estimate for the life of a project. The R sub M is the estimated return on the market, and then the beta, the B sub I is the estimated beta for the firm. And again, it's the relevant measure of risk for a particular company. So we can just plug in the pieces into the CAPM equation. We'll come up with an estimate of the required rate of return for a stock, and that's the CAPM method. There's also the dividend yield plus growth method, or it's also called the discounted cash flow method. And there we're going to simply take the dividend yield for a stock plus the estimated growth rate for the firm, put those two together, and that'll be our estimate for the required rate of return. So the rationale behind this method here is to take that pricing model where we have the price today, P sub 0, is equal to the dividend, the next period's dividend, D1, divided by RS minus G. If we just rearrange and solve for the R sub S that we care about, again, R sub S is the required rate of return on the stock, we get this equation here, where R sub S equals the D1 over P0, that's the dividend yield, plus G, which is the growth rate. So hence the name dividend yield plus growth rate. So the dividend and the price are things that we can easily observe in the marketplace. G, we're going to have to come up with some estimate of that, and there's a few different ways that we can do that. The first is to look at the historical growth rate for a firm. So here we would just examine the growth rate in earnings or dividends over a particular period of time and use that as a proxy for the ongoing growth rate. So if earnings growth and dividend growth has been relatively stable, this will probably give us a good estimate for the G. Another way to go about estimating G is to use the retention growth model. And their earnings growth is going to depend largely on how much the firm earns on its equity, so the return on equity, and also how much income that the firm retains. So the money that the firm makes that they do not pay out in dividends, they're going to keep, that's going to continue to grow at that by the return on equity amount. So the overall growth rate for the firm will be equal to the product of the return on equity times the retention ratio. So if we take those two numbers, multiply them together, that's going to give us another estimate of the growth rate G. A third method is to look at analyst forecasts and use their information to estimate the future growth rate in earnings and dividends. And a third method to estimate the cost of common stock, we've got the CAPM method, we've got the dividend yield plus growth method. Now we'll just look at the bond yield plus a premium method. So this is taking the yield on the firm's bonds, and then we're going to add to that a risk premium because the equity for a firm is more risky than the stock, and by taking those two pieces, the yield on the firm's bonds, adding a premium, will come up with some estimate of the required rate of return for the equity for the stock, and that'll give us the component cost. And historically, this premium has been anywhere from 3 to 5%, and that'd be a number that I would need to provide to you. But you can calculate the bond yield based on pricing information, etc. And then just tacking on a premium, we would have this third way to estimate the cost of equity. We've already talked about adjusting the cost of debt and the cost of preferred stock using flotation costs. Let's go ahead and look at how we would adjust the cost of equity for flotation costs. We're going to again use that factor F, the flotation cost, and we'd use this equation here. The cost of equity, R sub E. Also, it's R sub S in other slides. Don't get too confused about the notation, but it's the same idea here. So the required rate of return for the equity is equal to the dividend, D1, divided by price, P sub 0, multiplied times 1 minus the flotation cost. So again, that product here kind of gives us the effective proceeds from selling new stock. And then we would add G. So as an example, let's look at this here. Assume the most recent dividend paid was $2. So that would be D sub 0. The growth rate is expected to be 5%. That's going to be our G. The price today, that's P sub 0, is $26.50. And the flotation cost, F, for a new issue is 4%. So if we plug everything in, the only kind of tricky part would be to figure out what the next period's dividend is going to be. And that's simply going to be the most recent dividend of $2 multiplied times 1 plus the growth rate. So in our numerator, we would have $2.10. The denominator is P sub 0 times 1 minus F, or $26.50 times 0.95. We take the answer and add 5% to that. And so our estimate for the cost of equity, including flotation costs, would be 13.34%. So let's do a couple of examples and put all this together. So in this example, we're going to assume that we're not dealing with any flotation costs. And we have a firm that has 20% short-term debt, 40% long-term debt, 10% preferred stock, and 30% common stock in its target capital structure. Now, I don't know if I've mentioned this in the last video, but the target capital structure is the appropriate metric to use for the weights, for the proportions. We wouldn't look at what a firm did in any particular year. We would want to be concerned with what the overall strategic direction for the firm is, and that should be captured in its target capital structure. And we also are going to assume that the tax rate, the marginal tax rate, is 40%. So a few pieces of information here. The cost of short-term debt is 6% before taxes. The current price of the 10-year bond for the firm is $895.55. It pays $40 coupons each 6 months, so $80 overall. The risk-free rate is assumed to be 2%. The return on the market is 8%, and the beta for the firm is estimated to be 1.85. And then finally, the price of the preferred stock is $22.22, and it pays an annual dividend of $2.40. So if we put all that together, apply the weighted average cost of capital formula to that, we should come up with 8.05%. And let me go ahead and go to Excel and kind of walk through this. So here I've got the different components on the left-hand side here. The weight, or the proportion of each component, adds up to 100%. The before-tax cost is going to affect the short-term debt and the long-term debt. And the after-tax cost will simply be the before-tax times 1 minus the tax rate. And because the tax rate is 40%, we'll multiply that times 0.6. And so we already have this after-tax cost of the short-term component. It's going to be 3.6%. We have some other information for the long-term debt. The bonds were priced at $895.95. We've got 20 periods. The payments are $40 each, and the future value is $1,000. So our bonds have a yield to maturity of 4.826% every 6 months. So we're going to multiply that times 2 to get the before tax cost of it. And then after tax cost, again, we're going to take that and multiply it times 1 minus the tax rate. So after tax, the long-term debt is costing us 5.79%. The preferred stock is equal to the dividend divided by the price. And the after tax is the same as the before tax. And then finally, for the common stock, we're going to use the CAPM equation. So we have a beta of 1.85 times the market risk premium, which was 6%, and then we're going to add to that 2% for the risk-free rate. And so the common stock has a required rate of return of 13.1%. Now to get the WACC, we're going to take each of the component costs, multiply it times the component weights, do that across all four, and then add up each of those four pieces. And so in this case we have the weighted average cost of capital of 8.0465%, and if we were rounding that to the nearest hundredth of a percent, which is fine for final answer, we would have 8.05%. Okay, so let's look at one last example here, and this time we'll use flotation costs, make it slightly more complicated. The flotation costs are assumed to be 1.5% for bonds, 4% for common equity, and 6.5% for preferred equity. The capital structure, the target capital structure for the firm is going to be 50% debt, 15% preferred stock, and 35% common stock. The current price on a bond, so here we need this information to figure out what the current yield of maturity is on bonds, and then take that to kind of work our way back and figure out what the effective cost of issuing new debt for the firm will be. So we have the current price on a bond is $945. The time of maturity is 12.5 years. And it pays $22.50 every 6 months. So let's go ahead and go to the spreadsheet and take a look at figuring out what the cost for the bonds will be. So first we have the price is $945. We have 12.5 years to maturity, and there's 2 periods per year. The payments are $22.50. And so the first thing we have here is our yield of maturity. So we would need to take that number, multiply it times 2 to get the annual rate, and that is going to be 5.10%. So the bonds that the firm has, the 12.5-year bonds, have a yield of maturity of 5.1% per year. Now, if the firm was going to issue new bonds, they would have to pay this 5.1% in coupons to issue bonds at the par value. So that's what we're going to assume. We're going to assume that the firm is issuing new bonds, that they're going to have to pay coupons that reflect the yield of maturity for the firm's existing bonds. And so we're going to kind of redo all this. So they're going to issue new bonds, and they'll have $1,000. The flotation costs were 1.5%, so we're going to multiply that times 0.985. The number of periods we're going to keep that the same. The payments, remember that it was 5.1%, so the payment is going to be $51. That would be using a coupon rate of 5.1% multiplied by 1,000, the face value. We're going to divide that by 2 because these are semi-annually paid. And then we're going to take that and multiply it times 1 minus the tax rate. So 0.6 is going to be the remaining number there. And so this amount showing up in our payments is the effective after-tax cost to the firm for its coupon payments. And again, the future value is $1,000. So once we throw all this into the mix, this number becomes our after-tax cost of issuing new debt. So this is our after-tax cost of debt, and we can place that over here in the after-tax portion. So this is the after-tax cost of issuing new debt, and we'll put that over here in this column. So the after-tax cost of debt, the effective cost, including flotation costs, is 3.207%, and we can just put that in over here as the after-tax cost for the long-term debt. So now we need to take a look at the preferred stock and the common stock. So the preferred stock, let's look down here, it's $50.40 is the current price. The dividend is $5 per year. So the formula to figure out what the component cost for preferred stock is, including flotation costs. Remember, that is the dividend, which is $5. Divide that by the price times 1 minus F. So in this case, it's going to be $5 per year divided by $50.40 times 1 minus the flotation costs. So we're going to have the $50.40 multiplied times 0.935. So let's go ahead and do that. So this is the dividend. This is basically the effective proceeds, or the net proceeds, that a firm would enjoy if they issued new preferred stock. And so the before tax cost and actually the after tax cost is going to be 10.61%. And then finally, for figuring out what the cost of the common stock is, we're going to take the next dividend of $3.40, divide that by the price of $47.50, again multiplied times 1 minus F. So it's going to be $47.50 times 0.96, because 4% is the flotation cost for the common stock. And to that number, we're going to add the 5.5% estimated growth rate. Before tax cost component is going to be this 12.96%. Again, the same thing for after tax. And our weighted average cost of capital will be 7.73%. And you have that answer here. So that's the figuring out the weighted average cost of capital without and with flotation costs. And we'll pick up with capital budgeting in the next videos on the following chapter.